Gold doesn't do anything, it doesn't grow food, pay interest, or power your car.
It pays no dividend, creates no wealth, it just sits pretty, still. So why is the value of this asset so damn hard to kill? It's not just its shine, its malleability, or its industrial use. I'm talking ancient history, fear of currency collapse, and economic dread. We're diving past the basics to what's going on inside our collective head. We'll break down the centuries, the big world wars, and why a shiny rock still holds its weight. So, let's be clear. What is this asset in the simplest of terms? It's backed by chemistry, by 5,000 years of documented history, and a universal agreement from cultures that transcends all the mystery.
See? It's not an IOU, it's not a contract or a government's fleeting promise. It's a tan promise. It's a primitive tool that modern finance can't quite shake off its hand. It represents something stable when all the paper money begins to fail.
To grasp gold's unique power, let's use an analogy that's both simple and fast. Imagine a rare, This ticket is physical proof of entry. It cannot be photocopied or burned. Paper money is like your regular concert stub that can expire and fade away fast. But gold is that backstage pass that's universally built to last.
When the paper current show gets canceled and the crowd begins to scream and run wild, this rarity, this trust, and this physical nature is what maintains its grip.
We'll break down what makes that parachute work, the physics, the history, so you can stop just wondering and understand gold's enduring mystery. So how does the gold value machine actually keep ticking year after year? It's a mechanism built on 4 pillars, driven by panic and fear. Step 1, rarity and the chemical properties. It's a non-reactive base. You can't print new gold, it won't corrode, it can't be erased without a trace.
Step 2, universal acceptance, documenting.
Step 3, no counterparty risk. This is crucial when systems bend and break. A gold bar is not a promise, it cannot default or be taken for goodness sake.
Step 4, low correlation. It often moves against the stocks and the bonds we know. It acts as the anchor in a storm, telling you where to go.
When the market's spinning wildly and the paper promises start to look faint, gold is the solid element you can trust without a single complaint. It's this combination of factors that holds its psychological weight, a physical defense system against financial collapse and a horrible fate.
So now that we know the basic rules of why the yellow metal is so respected, let's see what happens when the financial systems get truly infected. Let's look at a prime example where this safe haven thesis came through clear as day. We're talking 2008, when the global economy was starting to sway.
The world's central banks were panicking, assets were frozen in a crazy plight. The S&P 500, the main stock index. But look at the counter move. Gold rose by about 25% in a short time frame. Investors bought the anchor when the market was shouting out its losing game. That's the flight to safety principle in a moment of pure financial despair. When confidence evaporates, you bet your wealth. Gold is always there to compare. It shows that gold's value isn't tied to corporate profits or some debt to pay. It's a lifeboat for your purchasing power when the world is swept away.
This ability to act as a hedge, a safe haven, that's what keeps its demand high. Now before you go and buy up every nugget, we have to look much deeper with grace. The narrative of gold being the mostly true.
Second factor, the strength of the US dollar plays a massive role that is key. Since gold is priced in dollars, a strong dollar makes it more costly, you see?
The third complication is inflation expectation, and it's something that you must know.
So, gold is a safety hedge, yes, but not in all types of stormy weather that may appear. Understanding the mechanism and the challenges means you're almost ready to go and invest. But how exactly do you get in on the action and put the ancient metal to the test? You understand the why, you understand the how, but now you need to find the access. There are 3 main ways you can buy gold, so let's talk about that process. The first and most direct method is buying the physical coins and bars with your hand. This delivers the ultimate zero counterparty risk you can understand. However, you need to store it safely. That's a security and insurance trade-off you take. And when you sell, you'll pay a higher premium, and for the broker's sake. Option 2 is the gold ETF, traded like any stock on the public exchange. It's super liquid and low cost, an easy way to get within its range. But remember, this is paper. It carries the counterparty risk you want to avoid. You own shares in a fund, not the physical metal that is deployed. Finally, you can buy stocks in gold mining companies that are working the ground. This is leveraged exposure, often moving more, all around. But understand, you're now exposed to company-specific risk, not just gold alone. A mine can flood, management can fail. It's a higher risk zone.
The right choice depends on your goal. For safety, physical is the true king, you see. So...
The financial consensus advises a strategic allocation, not an all-in-one bet. You're looking at around 3 to 10% of your net worth that's set. This portion is your insurance against hyperinflation and systemic market disaster. It's meant to hold its purchasing power when everything else moves faster. Because gold's real value is less about making you wealthy with a giant surprise and more about keeping you solvent when global economies decline and fall before your eyes.
So that's the science, the history, the mechanism, and the way to buy with skill. Now you know why this yellow metal's value is so damn hard to kill. If you learned something new, hit subscribe, like, and share the word about the flow. I'm the money guru, here to make your financial knowledge rapidly grow.
Peace.